Hello, everyone. My name is John Kosar. I'm the Chief Market Strategist at Asbury Research and Asbury Investment Management, both in Chicago. And today I'd like to show you a couple of models we use. We are a quantitatively driven shop. We are firm believers in following the data rather than all the noise and news that seems to be swirling around the markets, especially recently. The first model is going to show us when to be invested, and the second one is going to show us where to be invested. So that first model, we call it the Aegis Six, and you can see it on your screen right now. There are 6 different tactical metrics here that we use to tell us the internal health of the market. Think of it as when you go to the doctor, he always starts with those same 4 or 5 things. He checks your pulse. He takes your blood pressure. He may check your reflexes. He may listen to your heart and lungs. This is what the Aegis Six is for the market. It mostly measures the internals of the market. There's only one up top, the rate of change, that has to do with the S&P 500's price. The other 5 are what I call secondary indicators. Investor asset flows, corporate bond spreads, market breadth, volume. So each day we update this, and it tells our clients when the market is strong and when it's starting to weaken, so they can start to make an exit plan should the market turn over. Right now, the Aegis Six is on a negative reading. It's been that way for a couple of days. You can see they're all red, and you can see all of the dates there that are in each of those individual cells. Tells you exactly when each of those particular constituents turned red or negative, and you can see that they're all 5/11 and 5/12, which is May 11 and 12. The second one has to do with where to be invested. So we are in a risk-off kind of a mode right now, so we are essentially out of the market or certainly pulling back on our holdings. But this model is called the SEAF model, S-E-A-F, it's sector ETF asset flows. This measures the sector flows in the 11 sector SPDR ETFs, and it does it in 3 different time frames. Trading, which is 1 week, tactical, which is 1 month, and strategic, which is 1 quarter. Right now, financials have been in favor in terms of asset flows. They've been in favor now since the middle of November. They've done quite well. The XLF, which is the SPDR, the sector SPDR for financials, is up 40% since November the 12th, and it has outperformed the S&P 500 by 18%. The other one that's coming into favor here of just the past couple of weeks is energy. So we are currently overweight the financials and energy markets. As our Aegis Six goes to a negative reading, we're going to tighten our stops on these so we don't give up a lot of the gains that we've captured here, especially in the financials over the past 4 or 5 months. But this is basically what we do. Should we be invested, and then where to be invested when we're on a risk on or an Aegis Six positive mode. That tells us what places that we should be involved in order for us to get the best return. In other words, to get the best bang for our buck. When the entire market's going up, it's healthy internally, as shown by the Aegis Six. We make sure we're on the fastest horses in terms of the sector space, and we do that by following the money. So again, our work, I've been doing this for 40 years, and the longer that I do this, the less I try to forecast, and the more I just try to surf the wave of money that is moving in and out of the market. So I hope that made sense to you, and we'll see you at the next one.